Hello, everyone, and welcome to the newsletter for October 4th. So today we're going to be looking at the Bitcoin and Ethereum markets, just a kind of a general overview from some of what we're seeing on chain. And what's quite interesting about what we're seeing play out is we've clearly had some fairly tumultuous and interesting news, right? The President of the United States is now crook with coronavirus. We had a $150 million hack, which I believe is the third largest of the KuCoin exchange. So I was thinking it's the third largest in this whole market's history. We've had BitMEX that's suddenly taken they've now got a fairly substantial and criminal investigation against them, and the co-founder's now been arrested. So there's been a lot of interesting and fairly impactful news that's hit the market of late, and quite amazingly, the crypto market has responded quite strongly to it. In fact, far stronger than I think most people were expecting. And what we're starting to see is a bit of a consolidation of these different metrics and what we're tracking on chain that's showing that people are really accumulating these two assets, Bitcoin and Ethereum in particular, and they are accumulating it for the long hold. And when we can start to see this, you can look at the difference in human behavior on chain compared to what you would expect in the news, right? And during a bull market, bad news is good news, right? And obviously during a bear market, all news is bad news. So, if we're starting to see this resiliency creeping in, we've got the macro backdrop that's behind all of these markets, and the, currency debasement and political uncertainty, and the notion of an apolitical money makes a whole lot of sense. And despite all of this chaos, the prices have more or less still held pretty steady. And I just want to talk through some of these different metrics to kind of build that thesis. And it's certainly to the point where I'm leaning, quite strongly bullish. And I think that this current dip is most definitely one for buying. I think there are opportunities that are starting to present themselves. And ultimately, you want to be following what the largest players are doing. And so we'll look at some of the metrics like supply held and transaction values and things like that, just to get an idea about what's actually going on for each of these networks. But ultimately, we'll be looking at that as from a resilient markets perspective. So 2020 has been a bit of a savage year for everything. We had the coronavirus sell-off back in March. We've then had recession and stimulus and almost all flavors in between for the last 6 months. I think if you kind of follow Raoul Pal's model, which is something that I still think is most definitely in play, we're in this kind of transition phase between the hope bounce and when reality really starts to hit. And we're going to start seeing that kind of melding of small businesses that are still challenged, and there's still a recession going on, but it's also the age of infinite stimulus. And how do these new assets perform in that particular landscape? What are the inflation and deflation expectations? We've now got the BitMEX lawsuit and arrest. I mean, I think it's 130,000 BTC. It's a non-trivial sum that's in there in the BitMEX insurance fund. My understanding is that they're enabling withdrawals on a frequent basis. So, funds are technically safe. But, BitMEX has had the biggest trading volume in this space for a very, very long time. And it's going to have a non-trivial impact on liquidity and market movements. But ultimately, I think it's a positive thing that BitMEX has got a bit of a reckoning. I think it's opened up people's eyes to some of the other existential risks, like, when does Tether finally implode? People are going to start thinking about this. But ultimately, if we were 6 months, even a year back, and BitMEX, was taken out by the regulators, and we were deep in the bear market, I would strongly expect that would be a major sell-off event. BitMEX was ultimately what led the massive drawdown back in March. So it's played a very integral and key role for the market for a very long time. And the fact that the market really shrugged this off with a couple of percentage point dip and then has largely been bought back, that is a signal that we have a fairly resilient bull market that's starting to take form. And then we've also got the election uncertainty and everything that goes associated with that. We're about a month away from going into the election in the US. Interesting that the world is kind of waiting to see what happens there. A lot of certainty in things is relying on what happens there. And ultimately all of these things form the macro backdrop within which cryptocurrency exists. So even though it may seem a little bit left to field or semi-detached these macro events. The ultimate reality is that all of these things are starting to become tethered. We're seeing connections between and correlation between the S&P, gold, and Bitcoin. They're all performing slightly differently. Strength of the dollar. All of these things play into forward expectations, and forward expectations is really how we set a baseline for what we expect to come in the future. So, all of these things, it's been a fairly savage year, but even despite that, if we now plot up, year-to-date performance, you can see the S&P and gold have got modest gains. Bitcoin sitting up there with a comfortable 47% gain, year-to-date. And then Ethereum's up here at a 266% gain. So, we're talking about fairly substantial increases in price. I mean, during a very, very tumultuous year, this is really notable performance. And, it's something that really had, you could have comfortably held just these two assets, right? Number one, number two in this market, and it performed exceptionally well this year. And, what I'm really seeing from the data that we're about to go through is I think that's a reasonable expectation to carry on into the future. I think that there's a strong group of holders that are being, a strong base of hodlers that are getting ready to hold this thing for the long haul. And that's the signal that we're into the bull market. There's been clear accumulation, which we see in the hodl waves. We've got, past accumulators that are still hanging on to it. We're not seeing the same amount of spent outputs. So we'll look through all these things, but ultimately year to date, this kind of thing in an increasingly financialized crypto market, and as things like BitMEX, which have always been a bit of a question mark in the eyes of regulators, and as these things slowly get weeded out, ultimately we're going to move towards a more stable, less volatile, more accepted type market. So, ultimately this is going to attract attention when it's the best performing asset class yet again. It's it's going to bode well for adoption over the longer term. And they've significantly outperformed. So even in the last couple of days, we had the KuCoin hack, which was 150,000 worth of everything from ETH tokens to Bitcoin and Litecoin and all sorts of altcoins. So actually, KuCoin really got hit pretty hard. So it's going to be interesting to see whether they recover from that. I think it's there's a lot of money missing in this particular mix. The hackers quickly discovered that Tether can be frozen and various other ERC20 tokens can be frozen. So the efficiency of their attack is somewhat questionable. Lots of people have said they're the biggest noob hacker that's shown up in some time. We had BitMEX, we had the president, all of this. I mean, it was a 3.84% drawdown in Bitcoin. Even though that's massive uncertainty, all sorts of changes. I mean, ultimately, if KuCoin was hacked for 150 million in the bear market back in 2018-19, it would have been an immediate sell-off, right? Just bad news was just heinous bad news. And we've kind of moved into this phase where, 3.4% is just another day in crypto, and it's already bounced back, the 1.6 or 50% of that. So, these are all signals that we're moving into a bullish market, because the market is essentially shrugging off what would otherwise be bad news, especially in a bearish market sense. If we just take it to the most crude and simplistic model, this is just looking at active addresses. And I know that it's not a perfect measure, but you can clearly see that there's a strong correlation between, if you put it into log scale, you can even get a different perspective. But ultimately, we are in an uptrend for Bitcoin active addresses, and we're in an uptrend in terms of price, right, on a weekly basis. It would make sense for us to have a pullback here, and I think that what this is going to do is shake out some weak hands, but ultimately the usage is heading north, and this is positive, right? More active addresses has historically been related with higher prices. So, this is just a really crude, but, it's clearly showing that there are more and more people using this network. And we're seeing the same with Ethereum as well. And we'll get to that towards the end. This chart has continued. We've talked about this for some time. This is the balances held on exchanges. And you can see that since the March sell-off, that was clearly a capitulation event. That was a line in the sand where hodler behavior really swapped over. And when I process how I thought about this, I remember the feeling of missing this rally back in 2019. Not necessarily missing it, I caught some of it, but most definitely I wished, we were all talking in the chat room saying, gee, I wish I got more of that. And, everyone was a bit shocked by this rally. And then I think this miniature bear market then shook everyone out. But as soon as we got this sell-off, people go, aha, here is my recovery opportunity. Get back in. This is where we start accumulating. And now we're seeing this distinct withdrawal, like a linear downtrend of BTC held in exchange. So since March, what is that, about 6 months, 300,000 BTC have been withdrawn. So, this is taking us back to back in early 2019. So more or less the same amount of BTC on the exchange as we had before this initial rally. So, again, that means that there's more supply being pulled out, even though we're at a higher pricing. So that is telling me that people are accumulating and self-custodying. Now, generally, if you're self-custodying, that signifies a longer hold. So shortly we'll look at some of the time-related metrics to this, but this is just showing you the magnitude of how much is actually being withdrawn. So it's a non-trivial sum. It's roughly about 10% of all coins held on exchange. And as you can see, we actually haven't been in a downtrend since maybe back here in mid 2016, which you can see if you look at this fractal. We have a linear increase in BTC on exchanges as more exchanges come online, and the fear of Mt. Gox starts to fade away. And then pre-bull run, we move into this period of mass withdrawal. This is a smart money accumulation because we're at the beginning of this trend. And this is really promising, right? We have pretty much the same fractal where we had this linear increase as people are selling, and we enter a bear market, more people are selling. Even with more custodial, you can look at Binance. They've got all sorts of other products where you can put your money to work and, get APY and stuff on your holdings. So there's all sorts of other products and incentives to use an exchange, and yet we're still getting withdrawals. And this is a really positive sign in my eyes. And this is a really interesting thing I need to understand a little bit more about. But if you look at the mean transaction volume, so this is how much is being transferred on average per transaction. Previously, we were at 2.8 BTC, right? Which is, it's a substantial sum. That's $50,000 or more. And then if you're looking at that's now jumped to 8.8 only in the last couple of months. So that's a 300% increase. But this here signals to me that there are large transactions moving around. This is not small transactions. So we've got lots being pulled out from exchanges, and we are seeing a significant uptick and a sustained uptick in the average transaction size. So again, this signals that we're getting more large players. This could be family offices, this could be larger hedge funds. There's all sorts of logic behind this, but this to me tells me a greater number of people investing large sums of money, more or less as an inflation hedge, because they believe that Bitcoin is going to perform in whatever the expectations are to come, whether it be inflation, deflation, or uncertainty. This is a strong signal that there are people who are accumulating large sums of it. So this is certainly an interesting thing to be watching, because you can see there's a distinct, it could bounce right back down, and this was just a blip in the radar. But this has been ticking on for a couple of months now. So it's a non-trivial data point now. It's not like one of these spikes where it's just gone up and pulled back. We're seeing a sustaining of these high transaction volumes. And if we look at the spent output profit ratio now, for just the Cliff's Notes on what this is, if you are holding a UTXO, there is a point when it previously moved. Let's say, and you look at the realized price at that time. So let's say it moved when price was at $10,000. That UTXO is then saved, for want of a better term, at $10,000. If you then spend it at $11,000, it's telling you what the magnitude of that profit actually is. And this is the adjusted model. So this actually uses, I believe it only considers UTXOs younger than 3 years. The assumption being that once they're older than 3 years, they're either lost or they're very, very deep cold storage. So they can be discounted from the economic model. So what we generally see here, and this is kind of another metric similar to the realized price. This is saying for each individual transaction, it's kind of the realized price on an individual transaction model, and you can see we've got somewhat of an oscillator. During bear markets, essentially you can see it acts as a resistance level, where we're getting this point where as price re-enters a point when everyone last moved their coins, there's then a additional sell pressure. It's that psychological, this is the price that I last entered. And conversely, during a bull market, you can see that it provides support in general. So it's essentially a buy the dip type level. So it's essentially bouncing along here, and then it switches over. We go through a blow off top, a transition phase, and then we move into this realm of resistance. So you can see that we broke through back in 2019, moving into this somewhat bullish market. We've then dipped back below and we had the March sell-off, and we've now entered potentially the next round of bullish sentiment. So, obviously we tried to break up and hold it here. It needed a little bit more time to consolidate after the move to $20,000. And now we're in this realm where if we can really hold support here, this is essentially saying that people are buying the dip, the psychological dip, and ultimately it all comes down to expectations. Do people expect Bitcoin to head higher? I think if we get a nice resistance bounce on this particular metric, that's another signal that people are most definitely buying the dip and they're not moving their coins that are at a loss. It essentially means that they're accumulating rather than selling coins at a loss. And this is very similar in the reserve risk. So what the reserve risk, which remains in this buy zone and has been there for some time, the reserve risk essentially looks at, it's a derivative of coin days destroyed. And what it's essentially saying is that if you don't move your coins, you assume that it's going to go higher. It's basically you are locking in an opportunity cost by making the decision not to sell. And likewise, if you do sell, then you are realizing that opportunity cost, and you are actually selling it to either take the gain or the loss. So what this is really telling you is that when it's in this green zone, it's suggesting that on aggregate, the market is happy to hold, not willing to actually sell the coins because they believe that there is a higher value or a greater purchasing power in the future, which ultimately is feeding to that store of value narrative. It's almost a bit of a self-fulfilling prophecy. The more people that believe this particular narrative, that it is a store of value, the more people are going to treat it as that. I'm certainly in that camp where I do believe it's going to perform as a store of value, and that's how I use it. And, the more people that get on board with that, and I think, we're starting to see these data metrics pointing to it. We're seeing more coins being withdrawn. We're seeing them being withdrawn at larger size. We're seeing this reserve risk indicating that, the opportunity cost, we're not talking about old coins that are being sold onto the market. The old coins are remaining held. So it's accumulating coin days. As they're not being moved. So that is that store of value narrative starting to really show up on chain. And if we actually look at the NVT and RVT ratios, which I haven't got in here, but in general, they've been maintaining very, very high levels, which means in a bullish market previously, we've seen very low levels. It means that there's a lot of transactions going on. This particular market cycle for Bitcoin, at least, we've seen a lot less transactions because, I think that we are entering that realm of store of value. It's going to be interesting what that means for the fee model longer term, because obviously those two are at odds with each other. But, this is what I'm starting to see is that in this early bull market, we're seeing the same fractals that we have previously, except in the transaction space. We're seeing fewer transactions, but higher value transactions. And to me, that's indicating that there's a new class of people who are potentially entering this market. And then when you consider the macro environment, it's a pretty good bet that these are, family offices and high net worth individuals and the like who are starting to get into exposure. It feels like a new class of people that we're starting to see on chain because of that change in investor behavior. And I think a lot of retail is probably shifting over into the Ethereum space. So you're kind of seeing this spillover. We're getting more institutional, larger players move into the Bitcoin realm because it's a macro hedge. And we're seeing more of the people who've spent time studying this market then overflowing into more of the DeFi and the new models that are being built in the Ethereum space in particular. And if we then look at the HODL waves, so this is essentially looking at what percentage of the total supply is a particular age, how old is it? So these darker colors up here are greater than 10 years, 7 to 10 years, 5 to 7 years. So you can see that basically the more green there is, so the green zone will capture everything that's 2 years and older. The more that expands, the more old coins are in circulation. So this is essentially telling us that around 60% of all coins are 2 years. This is the other way around. So this would actually be 40%. So 60% of coins, those below, are 2 years or younger, and 40% are older than 2 years. And you can see these bumps in particular in the 2 year zone. So what you would essentially look for is if we're getting an increase in our 2 year accumulation here, that's saying that these people were buying back here, which is essentially buying in at the big dip of the bear market, somewhat a bit early, but we're seeing that people who bought back here and now their coins are aging, so they essentially have not moved since they were accumulated back here. And we're seeing a very similar fractal playing out where during the 2018 bear market, this is where the coins that are forming this bump here, they were essentially purchased back here in 2018. So that's saying that we're getting these aging coins that are now reaching, a 2-year maturity. And you can see that in the 1-year maturity, if we take a slightly smaller zone here, again, those coins that were purchased back in the peak in 2018 are now coming of age, and they've essentially maintained that, call it a market share. But over time, we're seeing that coins that are a year and older are actually increasing. We're getting less of these darker red colors, which are young coins, and more of the older coins. So again, that's feeding into that. People are buying into this thing to hold on to it for 12 months or longer. And that's that store of value narrative starting to show up on chain. Now, obviously, some of these darker colors are most definitely going to be lost coins. And the market behavior back here, when these 5-7 year-old coins were actually purchased, very different market sentiment and structure back here than it is today. So it's going to be interesting actually to see how the HODL waves play out over time, because we're going to see this shift in narrative start to show up in the 1 to 6 month type HODL wave colors. So where this goes, we could end up getting this oscillation of 2 years, and it could very well be that after a handful of these cycles, we'll start seeing these particular oscillations when you're seeing the smart money getting in. And because you get these waves, it could indicate that, the holding pattern is typically about 2 years, right? Buying at the bottom, selling at the top, roughly a 2-year cycle. Half of a 4-year cycle. So it's going to be interesting to see how this plays out. But again, this is telling me that we're getting some of those coins reaching maturity, and it means that the coins that are being purchased today could very well be being held for that 1 to 2 year move, which again is going to constrain supply. So we're getting larger holders, more people are withdrawing, and the willingness to actually hold these coins longer term. And then looking at the size of BTC held in different accounts. So I've got 2 slides here. This is looking at retail investors. So we're talking about, anywhere up to 1 BTC. But in general, you can see we've got an uptrend for, the 1%. This is the stacking sats type holds. They're at all-time highs. We're at all-time highs from the 1 to 10% of a BTC. We've got an uptrend in the 10% to a full BTC. And that's kind of my limit for retail, because generally retail is going to be falling within that up to $10,000-$11,000 range in a single transaction. Obviously, people could hold multiple of these, but this is the stacking sats in action right here. These 2 in particular, all-time high and really moving in that uptrend. And then if we look at the whales, that is pretty interesting. So if you look at the 100 BTC, we've had a slight reduction. In fact, that's not a slight reduction. That's going down from 10,000 to this is something around 3,000. So that is just a fairly substantial dip. But interestingly, our 1,000 BTC and our 10,000, it's a bit hard on a log scale to see these, but these are indeed in an uptrend. The 10,000 has been fairly static around 105, 110. It's kind of traded sideways for a long time. But the 1,000 BTC is most definitely in an uptrend. So this if you're buying in these 1,000 BTC type addresses, I mean, I'm sure a lot of these institutions as they're entering would have different strategies, multi-sigs and splitting up the coins across different wallets and keys and things. But in general, we're getting an uptrend in the 1,000 BTC, and interestingly, a downtrend in the 100 BTC. So we're down there and then up in the 10 and the 1,000. And if we look at the Ethereum equivalent, so this is again going back to active addresses, you can see, I mean, this is all very, very clear and distinct correlation. You can see here that from March, this is really where we saw DeFi starting to pick up. And I would think that active addresses in Ethereum is probably closer to reality than it is for Bitcoin, because for Bitcoin, you can obviously have many addresses for each transaction. For Ethereum, you're more likely to have 1 or 2 accounts where you set up all your DeFi protocols and your approvals and all that kind of stuff. So we're clearly seeing that shift. Now, hopefully we don't move into a downtrend here with this active addresses. There's probably going to be a bit of a cool off as some of the yield farming slows down, and some of the people who were in here for just the pure speculative hype probably dissipate a little bit. Who knows? We could get another round of hype, but this is clearly a strong trend. So I'd be keeping an eye on Ethereum active addresses actually, because I think it's a more valid metric than it is for Bitcoin and other UTXO chains. To me, this is actually giving me a reasonable signal that if this uptrend continues, then it's pretty happy days for ETH as an asset. And interestingly, so this is the balance on exchanges. So we've seen a very similar growth in ETH held on exchange. Now, we've seen a very significant dip across all major exchanges in the last couple of days, which is very interesting. And I need to understand what this actually is. I initially thought it might have been the KuCoin hack, but it's it's in there, but it's not the main driver of this drawdown. So this very well could be a mass withdrawal. We've also seen some murmurs that there's going to be an ETH2 testnet or mainnet first round being launched in the near term. We'll have to see if that actually plays out. If that narrative is true, and they do launch a mainnet and we see significant ETH moving on to actually start staking, this could very well be a withdrawal pattern as people trying to get custody of their coins to enable staking services. So we'll see how that pans out, and I need to have a look into ETH2 and see how that's tracking. But if the rumors are true, that's probably going to be a hype trade that comes in the near term. And in the hodl wave equivalents, we're seeing much the same, where we're seeing a reduction in these shorter term holds. Noting that Ethereum is going to have a lot more coins moving around because you've got people who are interacting with DeFi protocols, and it's a more active, hands-on type chain than the store of value like Bitcoin. But we're seeing this expansion of older coins, right down to the 6-month age. We're seeing that the market share is actually expanding. We're seeing, in this green zone, this is at 2 to 3 years. We're seeing an increase in those long hold times, increase in these 5 to 7 years. So we are seeing this increase in holding pattern over time. And the general trend here is essentially getting in a downtrend for these red colors, which is the shorter term holds. So that's a bullish long-term hold constraining supply type system. And if we then look at smart contracts, which is another kind of supply sink for ETH, you can see that it is also moving into a fairly strong uptrend. And I believe that this uptick here in particular is largely associated with Uniswap mining. So I'm sure you can go back and actually track some of these dips and moves to various protocols coming online, DeFi protocols. But this in particular is a combination of locked-in DeFi, the hype that surrounds all of that, but also the Uniswap liquidity mining, because everything is basically a pairing with ETH, or ETH is the easiest thing to pair things up with, and be a liquidity miner to actually get a handle on those coins. There's a 14.4% increase. I think this is a roughly doubling in a period of a couple of months. So it's starting to form a real sink for ETH value, and that's going to constrain supply as well. So we're seeing more people holding onto their ETH for longer periods of time, and which is conviction, and we're seeing more of it getting locked up into supply smart contracts, which again is a supply sink. So, to just kind of summarize all of that, we've had some seriously impactful news in the macro sense, in the crypto market sense, so both internal and external. I've been very surprised and impressed at how well both ETH and Bitcoin have shrugged it off. I think Bitcoin, my gut tells me that Bitcoin is probably a more likely play at this point in time. I think it's been left in the dark a little bit long. I think it needs to go for a bit of a run and get everyone panicking to get hold of more of it. But ultimately, they've been fairly resilient markets. It's been quite impressive, actually, to see the performance given the magnitude of the news it's hit. And again, when you can shrug off bad news, it's probably a good sign that we're entering a bull market. So, it's really adding fuel and conviction to that particular position. The growth in addresses and the balances of both retail and whales it's notable. And the mass withdrawal from exchanges, if we see that downtrend continue for Ethereum, unless that's just a short-term noise or it's some particular event that I'm not privy to. But overall, the withdrawal of BTC from exchange is really bullish. That's something to be we've been talking about that for some time. And, that's something that I think is really, really meaningful, especially in this type of landscape that is self-custody, and that is a bullish signal. And, you know, if this ETH2 testnet or mainnet, whatever the launch is that they're coming out with for the beacon chain, if that really is true and starts getting some legs, I'm going to be very curious to see how many people actually lock up their ETH to take advantage of it. Especially considering the types of gains that exist out there in DeFi otherwise. We're seeing DeFi supply sinks that are, you know, creating additional sources for consuming ETH and taking it off the market, liquidity mining and all the rest of it, which I think is going to work both ways. So during the bull market, it's going to constrain supply and push price up. During the bear market, as people, you know, try to withdraw and cut their losses and everything else, I think it's going to work to the downside as well. So I think Ethereum is going to perform as a how would you term it? I think it is going to be a true oscillator around Bitcoin, where it's going to rally harder and it's going to collapse harder. Is my instinct at the moment. And I was playing around with the Synthetics Layer 2 optimistic system, where they've got, you know, if you staked SNX in the past before the snapshot, you can basically try out their minting system on L2. So it's basically it costs you nothing in terms of fee. I think that's temporary. I think that they do have to put fees on at some point, but you essentially sign a message. So you don't have to pay a gas fee for the transaction, and the thing seems to work. I don't know when those coins get released or how they get released back to the main chain, but I think all of these things, different scaling and L2 solutions, is going to create hype. So I still think that Ethereum has a good ways to run from here. I think it is going to act as that accelerant over and above Bitcoin. And I think ultimately we're seeing these narratives starting to play out. I think we're seeing more institutions and high net worths really taking Bitcoin seriously as an investable asset, particularly with the macro backdrop. And I think we're seeing more and more innovation and people using the technology on the Ethereum stack in particular. So I think retail is really focused on that area, and that's going to be bullish for the project. So I think that at the moment, I'm very impressed with the resilience in these two markets, especially given what's been going on in the world. So I hope you're all doing well. We'll have our catch-up call for this Sunday. I will be out for next Monday's call, but as always, you can always grab me in the chat rooms. And I'm sorry I've been a bit quiet for the last couple of weeks. I've been flat out on a long hours on a construction site. So if you do need me, just at me. And otherwise, I will catch you for hopefully another catch-up session for next week, and then again for next Sunday's newsletter. Otherwise, thanks for tuning in. Cheers.